Hello everyone. In the first part of the video, we are going to discuss about the book You Can Be a Stock Market Genius and then about the current affairs. In the first chapter of the books, author discusses about the challenges professional faced. For example, his friend Bob, who manages $12 billion but still outperforms the market by 2 or 3%, might sound normal, but portfolio this size limits his option from 8,500 stocks to only 1,200 stocks over 1 billion market capitalization. These are the challenges that an individual does not face. He also tells us about how people think perfect diversification can eliminate market risk, that is, up and down movement of market, but it eliminates non-market risk, that is, related to a company-specific risk like burning down of a factory or a product which customers do not like. This type of risk can be eliminated by increasing the number of stocks. But after 6 to 8 stocks in different industries, the effect is small. Keep your analogy simple, like a deep plumber analogy. He takes $5 for banging the pipe, another $95 to know where to bang it. So finding an undiscovered and undervalued stock is very difficult. But when you find that one bargain, the upside is huge. So in stock market, $95 is for finding that location, and rather than assuming great return can only come from taking high risk. If you put in the effort to study and analyze properly, you can find investments where the odds are in your favor. The high return you earn won't come from taking reckless risk, but from doing thorough research and making smart, well-informed decisions. Just for diversification, don't invest in the stocks where you are not sure. The best investor don't invest all the time. They wait and invest only when they strongly believe they have an advantage. By focusing only on situation they understand well and feel confident about, their chances of success becomes high. If you keep your portfolio focused, prices may move up and down a little bit more in the short term, but that small extra volatility is worth it because over the long run, your returns should be much higher. Where are the stock market profit hiding? Exceptional returns often come from special market corporate situations like mergers, spins off, bankruptcies, restructuring, or asset sales. These events can create unique opportunities, but they require effort and patience. Some situations takes years to play out, but others happen quickly, so you only have a short time to hold and then sell. In this situation, you cannot take the benefit of long term tax. We cannot track every corporate announcement, but for finding one or two monthly can make us a good return. Over to Gaurav.
Hi guys, let us understand a very crucial concept, the concept of demergers. Demerger is a corporate action in which a business might choose to demerge or spin off a subsidiary or a segment into a newly formed independent entity. Demergers have been a great way for investors to create value. Now, let us understand crucial terms regarding demerger. The first term is the resulting company. So, in order to understand this, let us take an example. Let us assume there is a company named ABC Limited. It has two segments, segment A and segment B. Now, the company chooses to demerge segment B. So, in this scenario, segment B we will term as resulting company and segment A will be termed as demerged company. The second crucial term is record date. Record date is the date at which, if we hold shares in ABC Limited, we would be eligible to get the shares of the resulting company, which in our case is segment B. So let us assume the record date is 5th July. And on 5th July, we hold 100 shares of ABC Limited. And demerger happens in a ratio of 1:1. So on 5th July, we would be eligible to get 100 shares of segment B, which is the resulting company. However, if we buy 100 shares of ABC Limited after 5th July, which is the record date, we won't be eligible to get shares of segment B. Now, let us understand why do demergers happen. The first reason is that the business might choose to demerge a segment because it is a very low growing segment and segment A might be a very high growing segment. So in such scenario, the business might demerge a company so that they could create value for the investors. The second reason is that both the segment operate in an unrelated industry. For example, let us say segment B operates in an industry which is related to FMCG and segment A operates in an industry related to aerospace. Now, these are two completely unrelated industries which have their own dynamics, their own nuances, and the management would like to focus separately on such entities. So in such scenario, the business might choose to demerge an entity. Now let us understand the timeline of a demerger. The first stage or the first step in a demerger is to get the board approval. After the board approval, the order goes to NSE and BSE, which are the national stock exchanges. After this, the order goes to NCTL, which is the National Law Company Tribunal. Once the NCTL approves, then the company is required to get the shareholder approval. In such case, a special resolution is passed, which requires 67% approval. Once this is done, then the NCTL finally approves the demerger. This is a long process. It usually takes a year to get this demerger done. Now, let us understand with numbers how demergers create value for investors. Let us assume there is a company named ABC Limited. It has an overall profit of rupees 90,000. It has two divisions. One is segment A, which is a highly profitable segment, and the other division is segment B, which is a loss-making segment. Segment A has a profit of rupees 1 lakh, whereas segment B has a loss of rupees 10,000. So in such scenario, the overall profit of ABC Limited would come out to be rupees 90,000. Now, ABC Limited decides to demerge segment B into a new listed entity named XYZ Limited. So now we see that it is a demerger opportunity. So what we do is we go and buy 100 shares of ABC Limited before the record date, right? So in such a scenario, if the demerger ratio is 1 is to 1, so we would be eligible to get 100 shares of XYZ Limited, which would hold the segment B. So we would have 100 shares in ABC Limited and 100 shares of XYZ Limited after the demerger. So let us assume we buy 100 shares of ABC Limited before the record date. Till here, ABC Limited contains both the division, segment A and segment B. So if we buy 100 shares at rupees 80, our overall investment would be rupees 8,000. After the demerger, we would not only hold 100 shares in ABC Limited, but we would also hold 100 shares in XYZ Limited. So let us assume once the segment B is demerged, the profit of ABC Limited would be rupees 1 lakh. Why? Because the loss-making division is demerged. So in such a scenario, the overall profit of ABC Limited would be the profit of segment A, and the profit of XYZ Limited would be the loss of segment B, which is rupees 10,000. So since the overall profit of ABC Limited has increased, the market would give it a higher price. So we own 100 shares in ABC Limited. So let us assume the share price goes to 120. So we would have a portfolio value of ABC Limited at rupees 12,000. And since XYZ Limited is a loss-making entity, but the market cap of a company can never be negative. For example, Zomato was loss-making for a couple of years, but even then it had a great market cap. So let us assume the market gives a share price of rupees 40 to XYZ Limited. In such a scenario, our overall investment of rupees 8,000 would turn to rupees 16,000, which would give us a 100% return. This is how demergers create value for investors. But demergers are not always such lucrative. We need to be very sure about fundamentals of the company. Secondly, we should also be assured that that the resulting entity doesn't turn out to be a private company, because if it is a private company, then taking an exit and getting a good return becomes very difficult. And the third most important thing is to keep a track of the timeline of demerger. We should be handy with the timeline and keep a track of announcements whenever they come. This is how demergers create a great value for investors. Now my friend will explain you the next topic.
Okay, let us now understand some of the nuances of investing in spin-off companies. So, first, let us understand why these spin-offs are mispriced in the first place. So, the first reason would be the indiscriminate selling. So, this means is that the shareholders, which are originally holding the parent company shares, which got the spin-off company shares without their will, would like to sell off their shares of the spin-off companies. So this will temporarily create a demand-supply mismatch, which can push the share price down. The second reason would be the institutional constraints. So they also wanted to sell off their shares, maybe because they didn't want to invest in this business model. And the second point would be that generally spin-off companies are very low in market cap. So as institutional companies have their own regulations and their liquidity constraints, they can't invest into low market cap companies. So that is also why they sell off the shares of the spin-off company. So, so now we understand why we get the spin-off companies at a bargain price. So let us understand now how to identify a winning spin-off as compared to a loser spin-off. So the first thing which obviously you would like to see is that are institutions selling their stake or not? Because if they are selling their stake, then this will push the price down. Now, the second thing which you need to look at, and I think this is one of the most important point which you need to look at, is the incentives with the which the insiders are getting. So, I mean incentives in the form of stock options or warrants. So, what this does is that it aligns the interest of shareholders and interest of management in a single line. So this means that the management is incentivized to scale up and to turn around the newly separate company. The next point which you need to look at is the amount of leverage which is getting transferred from the uh, parent company to the new company. So what leverage does is that it magnifies the returns which you can earn. Like for example, in this example, 100 crore of asset uh, is getting is increasing by 20% from 100 to 120 CR. But due to the high leverage, the equity value is essentially getting doubled, which means if keeping the price to book value same, let's say the price to book value is same after the increment in assets, the stock price will double in value. Yeah, so these were all the broad points which you need to look at to identify winning spin-off. So let us now look at the case study of Marriott Hotel. So what this was is that the setup was simple. There was a good company and a bad company. So the bad company got all the debt and all the underperforming assets, and the good company, which was earning high revenue and high margins, essentially made their balance sheet clean and debt free. So if you can make a checklist of all the points which we discussed earlier. So this company was essentially ticking off all the checkpoints. For example, the leverage checkpoint, which we discussed earlier. So this company also had $25 per share debt and only $5 equity per share. So the leverage was very high. The second point would be the management incentive. So the bad company's CEO had a tremendous amount of stock options in his incentive plan. So this also aligned the interests of management and shareholders. And the third point would be the indiscriminate selling. So due to the high debt and unwanted business model, people started selling off the bad company shares. So all the checklists were tick marked. And if you would have invested in the bad companies, which is the host Marriott's company shares, in this time, you would have tripled your money in 4 months. So now you understand the value of investing in spin-offs. So yeah, so let us move to the risk arbitrage point or the topic. So the before explaining this topic, I would like to say that this model essentially is not a very great model to earn money, and it do have its own drawbacks. So the framework is simple. You try to earn from the spread. So for example, a merger is announced at a date, and the acquirer company is saying that we'll acquire the target company's share at $40 per share price. So and after this announcement, the share price jumped to $30. So what your model is basically, you are trying to buy 38 and sell it $40, essentially earning $2 per share. But this to earn this $2 spread, you need to take a huge amount of risk. So the risk comes from yeah. So the risk here is that if for any reason, for any changes plan or change in anything which the acquired company found out about the target company during the due diligence, or some plan changed, it and the deal is called off, then the share price, the $30 share price, or the target company share price would fall tremendously. So, for example, if the target company's share price initially was $20 and it jumped to $30 after the announcement of merger, uh, and the deal was called off, so the $30 share price would fall back to $20 again, which means that uh, you essentially lost $18 per share. Uh, but if the deal was on, and if the deal was done, then you would have only made around $2 per share. So the risk to reward ratio is very high. Yeah, so this model historically has not been a very good model to earn money. And yeah, I also suggest to not rely on this model to earn money. Yeah, so now I would like to pass on to Divyansh to explain further.
Let's understand another two type of spin-off in which and we will be understanding how the unlocking of hidden value will be happening. So first is partial spin-off. It generally occur when the parent company is dividing its subsidiary company but less than 100%, which basically means its minority or the stake will be getting division and the remaining will be retained by the parent company. So in this, how the value will be unlocking? As the new listed company will be getting its value in the market, so we can calculate the full value of the subsidiary company, by which we will be using the formula of the parent company market cap minus the subsidiary company market cap. So we will be getting actually known the how the market is giving value to the parent company. So which will be helping us to know whether this is an right value or not. So let's understand it more better way in a case study of Sears and Dean Wilder, in which the Sears is the parent company and Dean Wilder is a subsidiary company. So they were the group of company in which it was very difficult to value the Sears as a parent company. So by spin-offing its 20% stake of Dean Wilder, the we can get the actual value of the company. So here the spin-off take place in which the Dean Wilder get spin-off by 20% by the Sears, to which the share price of the Sears was $54, in which Dean Wilder value was only the $15, which will be getting reduced. And the another subsidiary was there named Allstate, which was another player. So its value was at $29. So remaining were the $10 value of Sears. So while the as a valuation comparison of done, the $10 is the value only the very low part of sales, by which the investor get the actual about the actual valuation of the Sears, through which they know that the market will be correcting the valuations of the Sears, after which the Sears get corrected and the 50% rose in the Sears share price was observed. Now let's understand another type of spin-off, which is right offering, in which the parent company basically the spin-off will be happening. So the subsidiary company which is getting spin-off will be need of money through they're the existing shareholder only. So they give right to their existing shareholder to buy the share of new entity in the basic ratio. So in this, there will be three options for the existing shareholder. Either they will be purchasing the share if they want to be the part of the new entity, or either they will be selling their right to the someone who is in need, so they can sell their right. Or third, if they not either exercise or sell their right, so they will be so their right will be getting lapsed, in which nothing will be happen to them. So in this, the right offering, it is considered as a very complex situation. So generally, it has been observed that the shareholders ignore to the right offering, because of which many times the shares get lapsed. So remaining shareholder get the opportunity to exercise the right and get the shares at the low price. In this the right offering, the existing shareholder gets the right to purchase new entity shares at a low price. So these benefits get to them. So let's understand the case study of TCI and Liberty Media, in which the TCI was the parent company and it want to spin off its Liberty Media due to, and the complex structure was there, and basically their government regulation was there from the Washington. So they spin off their entity in the form of using right offering method. So they get the money also, and the spin off also happen, in which they want to spin off the 2 million shares. But the very low exercise was happened by the retail investor, mainly reason due to that the very confusion was the structure how this will be happening, and the negative media sentiments were there for Liberty Media, due to which only the 7 lakh shares approximately were issued. So how this become an value unlocking? So very less share were issued due to less applications. So the remaining the shareholder, the insider, the John Maloney, the subscribe more share, and the benefit it get the share at the very low price. So here the value unlocking happen for it. There's as the very at the cheap price the share got to the John Maloney. So after which the share surprise in the next 2 years the share outcome the return, and it become 10x. Over to Meet.
Hi everyone. So now we will be quickly understanding the special situation of bankruptcies and its investment framework with a couple of examples. So when a company defaults on its debt obligations for more than 3 months, the creditors, which are the banks and financial institutions, can file for the insolvency of that company under the Insolvency and Bankruptcy Code 2016. So there arises some opportunities to invest in such a company, but keeping in mind various aspects, which are first, never invest in the common shares of the recently filed bankrupt companies because of the concept of hierarchy of claims, which is denoted by a totem pole in the book, which basically means when a company is filed for bankruptcy, the shareholders are the last ones to get any claims upon the liquidation or sale of assets of that company. And in real life, in majority of the cases, there is nothing left for the shareholders at the end, essentially meaning that the value of those shares becomes zero. So generally in both cases, whether a company is getting liquidated or is restructured. Second, we should only look for investment opportunities in those companies which were good businesses, generally meaning good returns on capital above their cost of capital, healthy and maintained market share, etc. But they were stuck in a bad situation of excessive leverage, which has the scope of rebound if the debt burden is reduced, and thus bankruptcy in such situations act as a legal protection for the company to breathe and restructure. The third, we only invest in those companies which have been approved for restructuring. So in this situation, either a new entity bids for the ownership of the company, which acts as a catalyst to turn around the business, or a new management is appointed itself who are well incentivized and brings about changes in the business aspects, which acts as a catalyst as well for the turnaround of the business. So for this one needs to track each and every announcements and approval, and read and analyze every document critically to judge whether the turnaround is possible or not. Usually the best opportunities arise in those rebound stories which are very small in size and are classified as orphan stocks on which there is not much analyst coverage or media attention. And in such turnaround stories, the bargain also gets created because of the anxious selling of the creditors of the shares issued to them against their debts, or the shares they recovered from their promoter pledging. So this was a broad framework that we should keep in mind, and now let's understand with some examples. In the book, Mr. Greenblatt explained the example of Chartered Medical Corporation, which operated 78 psychiatric hospitals and 10 conventional hospitals. So it was a good business but went bankrupt because of heavy debt, which the company couldn't service because of their profitability declined due to the pressure from the insurance companies to cut their costs. So when it went bankrupt, the common shares were wiped off completely and the ownership went to the bondholders. Now, in this case, the investment opportunity arose when the management announced the plans for the rebound, which included cutting operational costs, marketing more to attract more OPD patients, and selling off their conventional hospitals to pay off their remaining debt as well, which resulted in Mr. Greenblatt earning around 3 times his investments in around 2 to 3 years of period. Similarly, we can apply this framework to an Indian company called CG Power and Industrial Solutions. So in 2019, the company was filed for bankruptcy because of various promoter frauds like related party transactions, related fraud, and accounting frauds. And mainly because of the company defaulted on their debt for more than 1400 crores out of total debt of 22,000 crores. So again, this was a good business with a market leadership in various industrial motors, switchgear products, and transformers, but stuck in a bad situation of excessive debt and promoter frauds. Then in November 2020, Tube Investments of Murugappa Group won the auction bid at 750 crores and bought the controlling stake of the company, which was a catalyst for the business. Well, now why such catalysts are important for us? It's because till the announcement, the company's share price was trading at around 5 to 6 rupees, which was down around 95% from its peak. And once this announcement came, the share price started rising incredibly, and over the time, the business fundamentals also improved significantly, resulting in more than 150 times of returns in around 5 years period. In Charter Medical situation, Mr. Greenblatt also said that he was glad he didn't sell his investments early on. Otherwise, he would have not been able to invest in that stock for over 3 years. And he said this to emphasize the importance of knowing when to hold the stock and when to sell the stock. So he explained that buying decision can be comparatively easier than the selling decision because buying is done in definite situations like buying when it is relatively cheap, buying undiscovered stock with a great upside potential, buying special situations, or buying when the management is more incentivized. But selling requires the clarity on whether the stock is tradable or investable. What it basically means is the stock whose fundamentals are very volatile or cyclical, whose growth longevity is forecastable for a very smaller period of time, are the ones, in very simple terms, the tradable ones. Whereas the stock whose fundamentals are pretty stable, with the growth trajectory visible for a longer period of time, are the ones who are the investable ones. Overall, the selling trigger should be defined in two broad categories, which are selling when your discovery edge is gone, meaning that you invested in a stock which was undiscovered with a good upside potential, and now after some time a lot of coverage is happening. But it comes with an exception if the company's fundamentals are still on a high growth trajectory, because this is the time when you still want to hold the stock, because even there might not be a significant valuation re-rating, but the growth itself will give us the good returns. And the second category is we should sell immediately if the fundamentals are not meeting even our conservative expectations, or worse, they are declining due to some sustainable reason. Thank you, and over to Jinai.
Corporate restructuring for Joel Greenblatt basically means selling a segment, typically a huge one, to unlock value that is being masked inside a conglomerate. When a company shrinks strategically, it allows the market to finally see what actually deserves a premium. We saw this in case of Greenband Brothers. It was primarily a low-margin wholesale distributor. Inside it, however, there was a small retail concept called Noodle to Doodle, a high-potential educational toy business. The problem was that opening new stores cost money, and in the early phase, those losses dragged down the entire company's profits. So on paper, the business looked worse. Now, when Greenman Brothers announced that they were thinking about selling the wholesale distribution arm and focusing on Noodle to Doodle, the market re-rated the stock, and it was now seen as a retail growth story and not a boring distributor. Sometimes getting rid of a profitable but low quality division is the fastest way to let a high quality business be valued correctly. Strategic shrinkage is another form of restructuring. It means deliberately becoming smaller to become sharper. Notably, in case of General Dynamics, after the Cold War ended, the US government began reducing defense spending. While other companies rushed into unrelated diversification, General Dynamics did the opposite. It sold its aircraft division and used the cash to buy back nearly 30% of its own shares through a Dutch auction. Management did not participate in the buyback, which signaled conviction. So the result was the transformation in capital efficiency and focus. Over time, the stock moved from mid-20s to total value of nearly 140 per share, including dividends. Now let's apply this in an Indian company, Larsen and Toubro. L&T was a massive conglomerate. EPC, heavy engineering, electrical equipment, IT services, real estate, road concessions. No doubt the valuation of such a company becomes murky. The EPC business is capital intensive, low margin, and balance sheet heavy. Infrastructure projects carry debt and working capital. Meanwhile, its IT subsidiaries were asset light, high margin, and high growth. If the market largely valued L&T as a construction contractor, the entire company suffered a conglomerate discount. Just like Greenman Brothers, a high quality business was being masked. Realizing this, L&T began shrinking strategically. It sold its electrical and automation business to Schneider for about 14,000 crores. The proceeds were used to strengthen the balance sheet and reward shareholders. Inside L&T, there were two mid-sized IT firms, Infotech and Mindtree. Individually, they were decent players, but inside a construction giant, they were invisible. L&T merged them, creating a large, focused IT entity. For the first time, the market could clearly see high margin, high growth tech business which was carved out of capital heavy parent. The final piece was infrastructure. L&T owns roads and power assets that depressed ROE. Kept on the balance sheet, these assets generated depreciation and interest costs that weighed on profitability. So L&T gradually monetized them through infrastructure investment trust platforms. An NIT is a vehicle that holds operational infrastructure and sells unit to investors. It removes capital-heavy assets from sponsors' balance sheet and replaces them with liquid proceeds. So for L&T, this reduced capital intensity, lowered risk, and freed capital for core business. By selling the electrical business and monetizing infrastructure assets, L&T structurally improved its return profile, and ROE began trending toward the mid-teens. Restructuring is the event that resolves these inefficiencies by identifying such situations early before the mask is fully removed, before the shrinkage is fully appreciated, and investor gains a real edge. This concludes the book, and we will now proceed to economic indicators, explained by Meet.
Okay, so from here on, we will see some of the important updates of the economic indicators. Firstly, on the consumption demand side, if you look at the CPI inflation, it has been way below the lower range of the RBI's inflation target range in the months of September, October, and November. The primary and the most important driver for this is the deflation in food and beverages, which accounts for the highest weight in the CPI basket, with deflation of around 5% in October and around 4% in November. This has also resulted in higher real incomes in the hands of the common people. It might sound contradictory that CPI is very low and still the consumer demand is very healthy. It is just because of the food deflation. Other than that, the core inflation is at a steady rate. Then on the passenger vehicle side, there was a significant growth in the months of November and December. In November, mainly because of GST 2.0 benefits and sustained demand for compact SUVs. And in December, it was majorly because of the high growth from rural India of about 32% due to deflation in food prices and various subsidies. And December also saw dealers of passenger vehicles liquidate their model year 2025's inventory using various attractive schemes. On the two-wheeler side, October saw incredible growth due to GST 2.0, but November saw a decline, obviously because of majority of the buying happened in October itself. And then in December again, there was a decent growth backed by buying of two-wheelers based on the anticipated of increased prices in 2026 and increased penetration of EVs. Now, let's hop onto the manufacturing side of indicators. India's manufacturing PMI reduced consistently in the past couple of months, mainly because of global export headwinds as new orders are a bit less and fading momentum of GST 2.0 benefits. On the IIP consumer durables side, the dip in the month of October was mainly because of the festive season, resulting in reduced working days, in anticipation of which there was a front loading of manufacturing in the month of September itself, which is evident with a healthy growth of 10% in September. And then in the month of November, the growth rate again rebounded due to steady retail demand due to GST 2.0 and low inflation requiring increased production of consumer durables. Then on the fiscal side of the indicators, firstly on the capex side, October and November 2025 saw significant decline compared to October and November of 2024, mainly because in October the degrowth was attributable to a high base of the previous year's October capex. On an overall basis, October and November saw such declines because of the high spending done already in the first half of the fiscal year itself, which is also reflecting in the IIP's growth rate since June 2025. On the revenue expenditure side, there was a significant decline in the months of September and October, mainly because of intentional cuts in non-essential spending, which was caused by loss of revenue to government due to GST 2.0 rate cuts. The decline was also attributable to the transfer of significant amount of funds to the state governments in this period. Then in November, the expenditure increased heavily because of major subsidies released, as mentioned before, for food, fuel, and fertilizers, and increased spending in the interest payments and welfare schemes like Manrega, which resulted in sustained high rural demand. On the e-way bills front, September saw healthy growth because of aggressive front loading by manufacturers due to festive season and GST rate cuts implementation. Then October saw moderation in growth rate due to, as mentioned before, the Diwali resulted in less working days and adjustment phase due to the implementation of GST rate cuts. Then November saw significant growth because of low inflation and GST rate cuts and post-festive restocking due to sustained high demand. GST collections in October were at the all-time high in absolute terms, and the growth rate was just supported by sheer volumes. Otherwise, realization side was very negative due to the GST rate cuts. And then in November, there was a decline simply because obviously the realization side was very low and the volumes didn't grow much. On the on the external side of the indicators, trade balance saw a significant deficit rise in the months of September and October and then moderation in the month of December. September was the first full month of 50% tariffs on India. September also saw a lot of gold imports due to anticipation of wedding and festive season. Then October saw massive gold imports which tripled due to Diwali despite very high prices and also tariffs, which reduced outbound shipments to US in the month of October, complemented by increased imports of oil and coal. But then November saw the moderation on the backs of exports growth of about 22% to the US despite tariffs because of diversification to newer supply chains in US by Indian exporters, including increased exports of engineered goods and electronics due to support of PLI scheme and China plus one tailwinds, providing competitive edge to the Indian exporters despite high tariffs. In the November, gold imports also saw incredible decline due to obvious reasons that it was heavily front loaded by Indians in the months of September and October. Now, over to Divyansh.
Now we will be beginning with the major updates of the economic themes. The first is major IPO trend. In the recent year, the IPO market is at peak. The issues done by the company in the 2024-25 is over the above 1,50,000 crore, which is highest ever in the Indian capital market history. So, what are the key reasons that drive this much issues? So, first is the liquidity rush. The major investments done from the DIIs and the retail investors from the SIP has been crossed the 30,000 crore per month, through which they also demand the new offering, so which they can also invest. Second is the private equity venture capitalist promoter has been very good way to take the exits, which is the IPO only, so they get the very premium listing as the valuations of the market are also high right now. Third, for the as a retail investor, this is more like a became an easy way to earn money, as the average listing gain day is over and above 25 to 30%. So it make them to easily make money. Fourth, specifically for SME IPO, the small companies have make SME IPO more like an pump and dump to get the list at the Indian market and get the easily high valuation. So it is more like became an easy way to list their company. Fifth, many investors make this IPO trend like more to get a lottery based system, not seeing any fundamentals or the how the company will be performing, in which sector their company is. They directly just decide to apply if the listing gains are there visible, and just make it as a lottery system. So this also drive. Now the issue which has been done by the companies is majorly the OFS. In the over the last 5 years, the more than 60-65% IPO amount has been raised in the form of OFS, which means the amount will be going to the promoter, PEVC, the existing shareholders, not to the company for the expansion or the repayment of debt, any type of growth. So why this OFS is coming too much? So the main reason is that the companies like AMC, bank, and tech companies, they have enough positive cash flow, but they want to just exit their private equity venture capitalists just want their exit. So because of which they came decided to bring an OFS through which they will be taking exit and the new retail investor will be coming in the business. And the one again thing is that OFS is a very smarter way to exit for the promoter. If we assume that the promoter needs 100 crore rupees, so he want to pay the 40% tax for the dividend which we will be taking from the business, for which he have to withdraw of nearly about 160 crore, through which he can easily withdraw 100 crore. Where if the he choose the option of the OFS, so if it is assumed that the market is very good currently, so it will be getting very good valuation through which easily it can issue the IPO and will be taking the exit of the 120 crore, assuming that the 15% is LTCG. So he will be only paying that as a tax 20 crores, and the remaining the 100 crore will be received by the him. So in this, the low tax will be there. Now, making to the conclusion, how the performance has been done by these companies till now, the companies who had listed in the recent 2 years. So there are the companies who had positively listed and give the huge gain, but after the listing, the 50% of the company who list above the issue price are now currently below their issue price. So in this, the people invest with the name of the high profile companies name like Ola Electric, the huge tech startups are there, the huge trend will be there. So they invest in the name of the businesses. But the later on the this businesses share price has been fall down, due to which loss has been occurred to the retail investor only. So this is how the market IPO trend has been over the recent years. Over to Anuj.
Yeah, so in global trade and tariffs update, there has been a major update of India signing FTAs with two countries, which are Oman and New Zealand. So both of these FTAs will help Indian exporters get duty-free access to both of the respective countries. And yeah, in terms of the US and India tariff update, US has passed a bill which allows US to potentially uh, impose up to 500% of tariffs to Indian exports. Yeah, so over to Jinay now.
In 2025, gold has delivered its strongest years in over 4 decades, rising roughly around 65 to 70% in rupee terms, outperforming equities by a huge margin. This rally was driven by three factors. First, global conflicts reinforcing gold's role as safe haven. Second would be monetary policy. Investors are expecting US rate cuts for 2026, which marked its price in gold since it would reduce opportunity cost of holding it. Third would be currency. Rupee depreciated nearly 5% in 2025, thus amplifying domestic gold returns. What's more important is how demand has changed. High prices crushed physical imports down nearly 60% year on year, but investors pivoted to financial gold. ETF assets doubled over 2 trillion rupees in just 4 months, when December alone saw 11,700 crore rupees of inflows. Gold bank loans jumped 125 year on year, prompting RBI to cap loan to value ratios. Now it's no longer just a hedge, it has become leveraged financial assets, introducing systemic risk if the price is correct. Now the market overview. Indian markets in 2025 look strong, but they are weak underneath. While Nifty and Sensex almost reached record highs, nearly 60% of the top 1,000 stocks delivered negative returns. This difference exists because index is highly concentrated, and top 5 stocks alone carry about 40% of the weight. Domestic liquidity is preventing a deeper correction. Equity mutual funds attracted over 3.2 trillion in 2025, while SIP inflows crossed 3 trillion rupees. This domestic money has absorbed heavy foreign selling, since FPIs withdrew around 1.5 trillion rupees. Primary market, though, is still booming. IPOs raised around $20 billion, which is now considered a new normal for India. Valuations are still uneven, Nifty trading at nearly 20 times earnings, while several consumption stocks trade at 40 to 70 PE despite slowing growth, whereas large financials remain reasonable. Sectors are sending mixed signals. Auto saw demand after GST cuts, but faced margin pressures from higher metal prices. Banks face liquidity stress and rising unsecured loan risk. IT is entering into a low growth phase while shifting towards AI. Manufacturing and textiles are under pressure because of US tariffs. Returns will now depend on earnings quality and capital efficiency, and not on riding the index. Thank you. Over to Gaurav.
Now, let us understand China plus one thing. India as emergence as a major smartphone manufacturing hub clearly demonstrates how China plus one theme is playing out. This field was earlier largely dominated by China, but now, due to rising geopolitical tensions, supply chain disruptions, and US China tensions, companies are looking at an alternative apart from China. Hence, they are looking towards India. And this shift is clearly visible in numbers. India today has become the largest smartphone exporter to the US, with the exports crossing rupees 50 billion. Out of these 50 billion, 75% were iPhones. This clearly shows how global companies are looking towards India. Also, Samsung exported goods worth rupees 17 billion during the same time frame. These numbers clearly demonstrate how India is emerging as an alternative to China in the smartphone manufacturing, and how India is how companies are looking at an alternative apart from China. Now, my friend Daksh will explain you the next topic.
Now, let's talk about rupee depreciation. In December 2025, Indian rupee reached psychological 90 and 91 per dollar level, and it reached to an all-time intraday low of 91.08. At the end of 2025, Indian rupee was Asia's worst performing currency and depreciating about 5%, and there were three main reasons behind it. First, rising US Treasury yields and geopolitical tensions between India and US pushed the capital back to US. Second, the FDI inflows slowed and FDI sold over 1.6 trillion rupees in 2025. Third, US tariffs on Indian goods and delays in trade weakened the confidence. At the same time, gold surge imported increased and widened the trade deficit. RBI initially allowed the rupee to depreciate, but then it spiked back to 91. Then RBI changed its stance to aggressive defense and sold over $30 billion in forex account and injected 3 trillion rupees in liquidity to prevent credit squeeze. Despite this, inflation was modest. November CPI number was 0.71%, but the impact of this was not equal. IT exports benefited while travel, auto industry faced higher costs. Now the market expects the rupee to remain between 89 and 91.5 in 2026. Thank you for watching this.